Okay, well, I'm going to raise a glass to everybody. Welcome you to our first FIAZI event post-COVID, and we're thrilled you can join us. Just a couple of housekeeping notes before I introduce Marty. A reminder that this event is actually on the record. There's going to be some media in the room, so that should be that's a slightly different thing. And thank you all for joining us. It's been a very stressful time for everyone. I think you know that Marty does not require any introduction. This knowledgeable group of fixed income pros, but I'd like to use this opportunity to embarrass him just slightly. Over his illustrious career, Marty's been called many redeeming things, and one of my favorites is the dean of the high yield bond market. Whether you know Marty as a past president of FIAZI, a fixed income Hall of Famer, a prolific author and book reviewer, a rigorous academic, or as the host of the annual NYSSA High Yield Bond Conference, one thing is for sure, Marty is an all-around great guy who works very, very hard to make people in our business smarter. So we're thrilled to have Marty with us to share some new research that he's conducted on a variety of timely topics. As you will learn, he's been doing in-depth work on ETFs, the crossover triple B space, and the historical context for modern high yield markets. But before I turn things over to Marty, I wanted to remind today's participants that FIAZI is preparing a number of initiatives to be additive during this very trying time. In addition to calls and WebExes like this, we are preparing to offer some professional mentoring and advice type of services to those who get displaced by the downturn. And I also wanted to mention, as many of you are aware, that our annual Hall of Fame Gala will be rescheduled as soon as we can reasonably host it for both our members and our honorees. If any members have any questions or suggestions related to topics for us to host WebEx like this, please relay them to Lauren or any member of our board. Last, I just mentioned that we'll have hopefully some time for some Q&A at the end. So if you have questions, write them down so that we can ask Marty afterwards. So with that, thanks again for joining, and thank you, Marty, for participating today.
Well, Mark, thank you. And I want to say, first of all, I'm really honored to be the first in this series, and I hope that I'll do a good enough job that it won't be the last. But I'm really excited, and I love the format here. I think this is the closest I'll ever get to being on the Hollywood Squares show with all the different pictures I'm seeing posted right now. So I'll be happy to take questions about current developments in the high yield market. My focus is a little broader. I really want to pursue what I perceive to be an important mission of FIAZI, which is to help bring out new knowledge and disseminate that. But I will touch a little bit on some current developments. So if we could bring up the first slide for my presentation. Okay, great. Okay, so here's how, and again, I wanted to focus on some new developments. You'll see my email address there in case there are some further questions or topics you'd like to pursue. It's always very valuable to get that kind of input and find out about possible extensions of the work that I've done already. And so I welcome any comments now or later. So we're going to move to the next slide. This was a little analysis I did that came out of a discussion with a subscriber to a newsletter that I publish that's focused on income investing. And the subscriber, we were talking about what are the desirable characteristics of a closed-end fund, and there are a number of things you can look at. Very important to us is the performance record of the manager. The leverage in the fund is also a consideration, but the subscriber was saying, well, the one thing we know for sure that paying a premium to net asset value is suicide. You never want to do that. So we had a good test of that argument in fairly short order, because that was just before the market began to tank as a result of the pandemic. And so over this period of February 21st to March 6th, I was able to analyze the sample that I had found in an article reviewing sort of best and worst closed-end funds, and those that had all the relevant data were a total of 61. 22 of those were at a premium to net asset value as of the beginning of this period. And as you can see, they actually had a better performance. Just when you say, well, you don't want to be in those highly risky premium ones, they actually did considerably better in the downturn at a negative 9.97 average price decline versus negative 12.92 for those where you supposedly had wonderful price protection by being at a discount to net asset value. For those of you familiar with some of the statistical techniques, the data that I've included below shows that the difference between the premium and the discounts does not quite make the standard that I think in scholarly work you'd demand to say with very high confidence these are statistically different. But I think we can rule out the idea that paying a premium is a recipe for disaster in a bear market. That's just one of those ideas that's out there. It's unsupported by any evidence, but widely believed. In reality, the discounts often reflect poor management at the closed-end fund, and so that fund, if that's the case, should fall very sharply in a bear market. And I think that was what we were picking up with this analysis. So, this is something I put in the category of market lore, not really supported by evidence. I think another example, just I mentioned, there was a New York Times story recently that was headlined, "Something weird is happening on Wall Street," and not just the stock sell-off. And I emphasize that characterization of weird. And one of the statements made in terms of how strange the recent downturn was, I quote, "Gold futures have been falling despite gold's historical role as a place of safety during tumultuous economic times," end quote. Well, in reality, over the past 25 years, on a monthly basis, 49% of the time, gold moved in the opposite direction of stocks, and 51% of the time moved in the same direction. And if we look only at the months in which the Standard & Poor's 500 index was down by 5% or more, which is when you really want to get that haven of gold, it was only 31% of the time that gold moved up while stocks were moving down. 69% of the time they went down together. There was a report that based on the FTSE index, you got 68% of the time gold and stocks moving in the same direction. Well, that was true if you looked at a 5-year horizon. So yeah, if you wait long enough, it looks like you get some protection. But again, people should not be thinking of gold as anything like a short-term hedge to their stock exposure. But I think there are some people, based on some of the press accounts of how strange and anomalous this was, evidently there are a lot of people out there who are under that misconception. If we move to the next slide, this is some, okay, there we go. And here again, and by the way, I don't want to, I know there's some media people involved, and I don't want to be critical of the press because it's very important to have that coverage, and a lot of the, the transparency of the market is thanks to the financial media. But I think part of their job is reporting what experts say about the market, and some of those experts have been on a real tear over the last, I think, going on a couple of years now about the disaster that's looming when all of those triple Bs, get downgraded, and the high yield market is unable to assimilate them, and really this is the end of the world coming. I see about a story every week on this topic, and always mentioned in those stories is the statistic that 50% of the investment grade corporate bond market is now rated triple B. And it's true. This is a graph that shows what that ratio has been historically. And yes, if you arbitrarily select a low point on this line graph as a basis of comparison, it sounds pretty scary that, gee, a much larger portion of the the high yield market is in the lowest rating category and of the investment grade market, and obviously poised to fall to below investment grade. But the reality is, look back there in 2002, 2003, that ratio of triple Bs to the total investment grade market was 46%. And yeah, 50% is higher than 46%. I don't know if it's something that you should be getting into a panic about, that it's higher than it has been in some periods in the past, 4 percentage points higher. A little bit more on this topic, if we go to the next slide. Here are some other facts that you never read in stories about the looming triple B fallen angel menace. That the creation of fallen angels historically has not been particularly associated with recessions. It's really been specific events that cause particular companies as you can see, in expansion years, that created the largest number of fallen angels. Most recently in 2016, a lot of energy companies downgraded because of conditions there, not unlike what we're seeing currently, but it wasn't because of the general downturn in the economy. Moody's has made a statement that I think would surprise a lot of people. I haven't seen quoted all that widely, but even in a recession there, and this was a statement made just last year, they think that fallen angels would still only be a small portion of high yield outstandings, and not likely to, and that this is a key word, independently disrupt the high yield market. If you have a recession going on, of course, you're going to have spreads widening, yields going up, but the question is how much is attributable separately to that fallen angel effect, and I'll say a little bit more about that in a moment. Another important point here that, despite my efforts, hasn't got a lot of visibility. I believe one sell side firm also did a study and came up with similar results. I think the implication that the people trying to create a panic about this are happy to have people be left with is that the reason that the triple B component has grown so much is that all of those higher rated single A or above companies got downgraded, and that's what swelled the ranks of the triple Bs. The reality is that accounts for only about a quarter of it. The majority of the growth in the triple B universe is the result of companies that were just not rated in the past, that are now in the rated corporate bond universe, and some proportion of them that were upgrades from double B. So, if it were the case that they were all downgrades that caused that growth in the triple B segment, you might say, oh, well, they have downward momentum and they're bound to be at double B at the next stop. There's not necessarily good evidence even to support that downward momentum thesis when you look at what happens to ratings as they change, but at least that would be a plausible kind of argument. I I also see the statement sometimes, well, if leverage were the only criterion, then something like a quarter of the triple B universe would already be rated below investment grade. Well, of course, leverage is not the only criterion. And if you're comparing leverage today with leverage to some historical period, yeah, it's higher because interest rates are lower than they have been in the past. So it's quite possible for a company to have higher leverage than it did at some point in the past and have interest coverage that's just as good as it was because the embedded cost of its debt is lower. And again, the leverage is not the only criterion. The rating agency strategic decision not to fire all of their analysts and replace them with a quantitative model. And as a result of that, they look at not only other financial ratios, but other considerations. So they're well aware that some of those companies are more leveraged than the typical triple B, and that the market in many cases reflects that. But that doesn't mean that they'll necessarily be downgrading those companies, and they won't necessarily be downgrading because earnings are sure to go down during the recession. The question is, for a cyclical company, does it fall to a lower than expected level during the downturn? The idea of rating through the business cycle is not quite as firm a policy as that may have been at one time at the rating agencies, but there's still an understanding that companies are going to fluctuate in their financial ratios over the course of the cycle, and that the ratings do reflect that expectation. The other big assumption in this, and this is almost sometimes stated fairly explicitly in the discussions of the fallen angel potential impact, is that everybody who owns a triple B bond as an investment grade portfolio manager must sell the instant it's downgraded to double B, and this is simply not true. If you take the life insurance companies, which are a major player in the corporate bond market, they have no such regulations. They are more in the position of being a forced seller if the bond actually becomes impaired, in other words, defaulting or being very clearly at the point of default. The downgrade does affect their reserving requirements, but they don't want to sell and take a loss if they can avoid it, because that reduces their regulatory surplus and therefore their ability to write further premiums. So they're, if anything, inclined not to sell if they don't think the company's really on a irreversible downspin. And as far as the pension funds, they are under ERISA. There's nothing that prevents them from owning below investment grade bonds under the prudent man kind of rule. I once called the 5 largest pension plan sponsors and asked them what their actual policy was, and universally they said, well, the worst thing we could do would be to sell right after the downgrade when there are a lot of other people trying to sell too. We don't want the manager of an investment grade portfolio to shoot us in the foot by getting involved in a fire sale under those kind of conditions. So we say to them, maybe over the next 6 months, we'd like you to get out of that because that's not part of your mandate to own speculative grade bonds, but do it in a way that won't magnify the damage to the fund. And that was the kind of policy that the New York City defined contribution plan put into place when I was an advisor to that plan in 2013. So I have some direct experience with that. Now, I don't want to say that the addition of fallen angels will not have any effect on the market. I did a study a while ago looking at some previous examples. One was a big addition to fallen angels because of a downturn in the energy market. The other had to do with the downgrading of General Motors and Chrysler back in 2005. That had the special impact of a single issuer that was larger than the typical ceiling on concentration in one individual issuer. So that, if anything, would have been worse than what we're likely to see in the current circumstances. And I estimate that you could probably expect to see about 60 basis points of effect from the fallen angels, again, independent of what else was going on at the time. So I hope no one will come back to me and say, well, there was a widening of X hundred and you said it would only be 60. The question is, can you isolate the effect of the fallen angels? Not an easy task, but I think we're talking about something on that order and not the end of the world effect that is perhaps suggested by some of the reporting on this that you see. So if we move on to the next slide, the background of the title here is that President John Kennedy used the term more than once, but most prominently in the connection with a dam project that he was launching, and had been criticized as a pork barrel project. But what he was saying was that when he said, use this metaphor, the rising tide lifts all the boats, was that by the spending on this kind of a project, this would help others in the economy and have an overall beneficial impact on GDP. And I've modified that statement to say that the rising tide lifts most of the boats, to emphasize that you do have a fair amount of dispersion. And focusing here on the high yield market, I took deliberately a very huge rally in the market in June of 2019, when the price of the index, not the total return, but just the price, was up nearly 2%. A very big gain for this market. And even in those conditions, 1 out of 8 of the issues in that index went down. And it was not merely the case that those were energy related, which is the reflexive response to anything like this, any kind of statement like this that you make nowadays. But 60% of those that went down in that huge rally were non-energy companies. Now, just to bring this up to date, in the just concluded month of March 2020, of course, a horrendous downturn in the market, and yet 2%, 37 out of 1,818 issues in the ICE B of A US High Yield Index actually went up. The second biggest gainer, with a 4.72% price gain in March, in the face of all of this that was going on, including a huge decline in oil prices. The second biggest gainer was EQT Corporation, a BB1 oil exploration and production company with a 17-year maturity. Also represented in the gainers were such industries as utilities, healthcare, telecom, technology, and some others. Just as a footnote about John Kennedy, as I mentioned here, he surely was aware that boats can sink, because he was the skipper of the PT 109, which through no fault of his, he was asked, how did you become a war hero? And he said, it was totally involuntary. They sank my boat. Kennedy did play a little fast and loose with some of these quotations. This one, although it's usually attributed to John Kennedy, we know that it was used by a regional chamber of commerce, the New England Council, well before he came on. It's not clear whether he borrowed it from them or got it from somewhere else. But one other quote he liked to include in his speeches was, "I'll hitch my wagon to a star, but I have promises to keep and miles to go before I sleep." And of course, this was a conflation of two separate quotations, one by Ralph Waldo Emerson and one by Robert Frost. Finally, his wife, Jacqueline Kennedy, pointed out this error, and he apparently corrected it afterwards. So a little bit of quotation history ties into that one. If we can move on to the next slide, I just wanted to put into a little bit of perspective this recent decline, and let me say, it is just way off the charts. I think that people are generally aware of that, but I just thought this was an interesting statistic to include. On the single day of March 9th, the spread on the high yield index widened by 104 basis points. There have been all of these years that you see displayed here where in absolute value, so it could have been a widening or a tightening, but the change in the risk premium on high yield bonds for the entire year was equivalent or smaller than we saw on this one day just last month. So I think this helps to illustrate that we're in totally different territory. I've been telling people who on the newsletter, don't be in a hurry to call a bottom on this. We're going to have some more volatility, very likely some more large down legs, and this is, I'm sure, been a large topic at all of your shops. But the other statistic I would cite in connection with this, just to give an idea of the magnitude of this, is the total return for last month for that ICE B of A U.S. High Yield Index was negative 11.76%. Interestingly, that was not the biggest downturn of all time. The worst month on record was October of 2008 at negative 16.30, and the best total return ever on that index was 6 months after that, in April of 2009 at 11.47%. So perhaps we can take some encouragement from the fact that we are likely to see some big gains down the road. How soon that will be depends on a lot of the factors that you see discussed from morning to night on CNBC, and a lot still unknown about the course of the coronavirus and how much of an impact it will wind up having on GDP. Somewhat encouragingly, in the latest week, we had a record inflow into the high yield bond market, as reported by Refinitiv Lipper, at $7.09 billion. Also, I should mention that the worst month in what I've called the Great Debacle of 1989 and 1990, and those who were around can remember just how bleak things looked. The new issue market in high yield came to a total standstill after February of that year, unlike the present, where we had Yum Brands come to market earlier this week, and TransDigm, Tenet Healthcare, and Restaurant Brands currently in the market. So at least for the time being, the high yield window has reopened. That did not happen in 1990. I remember very vividly being on a business trip, being in a little diner to have lunch, and struck up a conversation with the fellow sitting next to me. He asked me what I did for a living, and I explained what I did, and he said, "There isn't a junk bond market anymore. It doesn't exist." And people literally believe that, that they thought that was the end. The high yield bond market was extinct at that point. It came back, and it's exciting to see that even though the high yield market just had a month more than twice as bad as the worst in that period, you really don't hear anyone talking about the high yield market becoming defunct. It's now a well-established part of the financial landscape, and I think the confidence is widespread that it would be back as strong as it ever was at some point. The question just being how long that's going to take. So let me end it there as far as my prepared remarks, and if we can open up the floor for questions.
I would be glad to unmute anybody. If you have a question, please raise your hand or ask to be unmuted.
Okay, I think Mark might be trying to ask a question there. Are you able to? Mark Howard,
Mark Howard, 1 minute coming up. There you go. Go ahead, Mark.
Thanks, Lauren. Sounds like we're in a fishing. Marty, questions for you. One is, you go to the site, see the list of it written, and your presentation. You've taken pleasure in challenging or discrediting the conventional wisdom. I'm curious what might be behind that inclination on your part.
As a corporate bond trader, and I did that for a few years, and then got into research, starting out as a credit analyst. But then when I went to head the corporate bond research effort at Morgan Stanley in 1984, they were interested in getting some more general kind of commentary. They were getting into the high yield market at that time and thought that having a high quality research product out there would be very helpful to that effort. So I started to do more market-wide commentary, and what I found that for the first couple of years I had plenty to write about, just debunking everything I had learned in my previous career as a corporate bond trader. People making statements about fallen angels automatically rebounding when they went to investment grade company. The bondholders being better off when companies cut their dividend because then there was more cash available to service the debt. And I found none of these things had ever been researched. It kind of dawned on me that said, where did they come from? And as I did the research, I found that in most cases it was just wrong. And it gradually dawned on me that these were just stories that bond salesmen made up when they had to try to get a sale off. And they said, well, as everybody knows, this is how it works. And of course, that wasn't how it worked. And nobody knew it because no one had actually done a study of it. So I've moved on and broadened the focus of my research since then, because there are many other important topics to address. But I've always looked back fondly on that era and find that even though I've published on some of these things, some of these myths, the market lore, as I term it, just is hard to extinguish. So from time to time, if there's a particular egregious example, I'd like to come back to it. But this piece, particularly on the closed-end fund that I started with, was sort of a piece of market lore that I had never looked into before. So I continue to get satisfaction out of going and looking and doing some empirical work to find out whether those ideas and sometimes the conventional wisdom is supported. I started trying to be open-minded about how it will turn out.
Lauren, I'd like to ask a follow-up question for you. And the historical tools, relationships market, that the linkages.
Give me a minute. I just need to mute everybody else. You should be muted. Everybody should. You and Marty are unmuted. Everybody else is muted.
Oh, well, it looks like Mark is still muted from what I see on the screen. Okay, there you go.
You got it. Okay. So Marty, in past cycles, the junk market has weathered recessions with very close linkages to the equity market. However, with the growth of the leveraged loan market and the Fed's involvement in the investment grade market, I'm curious if you'll be watching different markers for high yield during the current 2020 recession. Are there certain markers that you think historically were robust that are not going to be as robust going forward?
Yeah, well, that's a great question. Currently, at least, it's coinciding with this sort of war going on over oil prices. Not to over dramatize it, there was an announcement earlier today, as you probably heard, that President Trump had claimed that he was able to get a concession of a 10 million barrel a day cutback in production. I think we'll have to see how that works out in practice. But I think with that in the background and with energy, although down because of the very severe price drops in price, still the largest segment of the high yield market by market value as well as by base amount outstanding. So to the extent that you don't see the same proportional effect in stocks, which have really been dominated more by a handful of technology issues, the connection with stocks will probably be somewhat different than it was historically. There have been some attempts in the past to look at universes more like the high yield universe. One time there was even an index, Drexel Burnham way back in the old days, published sort of an index of stocks that were represented in the high yield market, or where there were so-called stub stocks, where most of the stock had been bought out, but a small amount remained outstanding. So there are probably better ways than the S&P to measure the impact with stocks. Of course, the experience of the last month has been typically what you see in a very sharp downturn, and even more so that correlations go to 1. Everything was down together. But as we get into what will probably still be a volatile period, but not quite as drastic a downturn as we get further into the cycle, the linkage with the usual stock measures may be less than it was. Energy prices perhaps more of a factor. The model that I use for valuation of the overall high yield risk premium takes into account credit availability, which is a measure you get from the quarterly survey of senior loan officers by the Fed. And of course, the less it is, generally, the wider the spread. Look at a couple of economic indicators, which are industrial production and capacity utilization. You might say, well, why not GDP and unemployment? But it's just empirically, those are the two that correlate the best with the spread. And then the other factor is the level of treasuries, which are inversely correlated with the spread. Now, during the last downturn, I added a dummy variable for quantitative easing because it was clear that without that, you were seeing the market being greatly overvalued month after month. And it's clear that there was something else going on, because ordinarily, if it gets to an extreme, after a couple of months, it comes back and gets into the more normal valuation range. So I took that QE variable off, made it a 0 as a dummy variable for a time, but eventually it was looking more and more like the Fed was doing it, whether they were calling it QE or not. So I reinstated that, and we'll have another update out in the middle of this month. In the last quarter, last month, the high yield market at that point was still somewhat expensive, but not quite as extreme as we had seen in some prior months. This month, of course, it is sounding as though that credit availability may be starting to worsen from some rumblings from the equity market. So if this turns out to be radically different, I don't like to just add variables on an ad hoc basis if I can avoid it. If things look very different, we may have to bring some other factors into the picture.
Thanks, Marty. Lauren, are there some other questions from the participants?
Yes, there are. Mark Gold, would you like to unmute, or do you want me to unmute you? There you go, Mark Gold, you are speaking now. Mark, hear you. All right, I'm just going to read your question. He said,
Well, shout out to Mark anyway. Hi, good to hear from you. Yeah, no, he's
okay,
saying in his chat that his audio is not working for some reason.
right. Okay, might differences in percentage price change reflect efficient pricing? Consider two portfolios. Portfolio one bought a $100 par bond, a premium, paying 105. Portfolio two bought a $100 par bond at $80. Portfolio one experienced a 10% loss, losing $10.50 or 10.5. Portfolio two experienced a 13% drop and lost a comparable amount. Does that make sense? That's what he wrote.
Yeah, it does. It does. I mean, I think the the arithmetic is indisputable. You know, if you can get enough underlying information on the actual portfolio holdings, which is not easy to do with these closed-end funds, then you might be able to to document that kind of effect. Of course, it would have to be systematic. That for some reason the fund was particularly concentrated there. It would seem on the face of it, it would be an awfully big coincidence if it just so happened that overwhelmingly the funds that happen to be selling at discounts were buying the issues with the bigger percentage price decline, or well, the bigger declines, as Mark has described. It would certainly, on the face of it, the difference between the fund itself being at a premium or a discount would seem to explain a large portion of the difference in the in the performance. So it'd be interesting to run those numbers too, just what kind of percentage of variance explained would be by that one factor. But of course, the net asset value, the premium or discount is versus the market value of their holding. So it wouldn't really be affected by whether they paid a premium or a discount for the bond initially. But it's an interesting thought, and that's why I say these questions are really valuable, because it suggests further directions to take existing research. I was doing this before email came along, and when email did come along, I said, well, this will be wonderful, because now it's so much easier than picking up the phone and calling with some feedback. Surely we'll get lots more feedback than we did. I don't know about the experience of others who produce research for a living, but it didn't really make much difference. I would love to get much more feedback, many more comments than I do, but unfortunately remains still a kind of an occasional thing, but almost always valuable when I get a comment on something that I've published, because it does give me some ideas of where I might go further, or factors that I hadn't considered that could help to explain whatever it is I'm analyzing. Mark, thank you for that question.
Mark Zane. Mark Zane asked, what about Carnival?
Yeah, well, it's interesting that that deal, for those who are not familiar, the Carnival Cruise Lines did a large deal, or was out there with a large deal being run by the high yield desks even though it still has investment grade ratings. But as you probably don't have to think too hard about why the proposed yield on that is significantly higher than that company would have paid just a short while ago. But the fact that they're out there with that is an indication that there still is interest. I heard one guest on NBC, and I'm not sitting there watching CNBC all day long, but I'm fortunate to have an exercise machine at home, and turn that on during the time I'm working out. And I did hear one guest today making the statement that this shows that people are just he didn't use the word crazy, but I think not perhaps as concerned as they should be. The fact that a cruise line is able to go out in this market on the heels of recent events, but it's certainly the case that the market is extracting a very large premium for that. So I don't think you can say that people have totally lost their senses on this.
For the delay, I don't believe there are any other questions. I basically said anybody can ask a question and just type something in the chat window, and I will unmute them, or they can either do that or they can unmute themselves. But nobody has as of this moment.
Okay, and again, let me just remind you, if you have a question later on. Oh, I guess there is one coming on.
Any research on closed-end funds and activist investors?
I haven't done it, and I'm not all that familiar with the research out there. Certainly, the phenomenon has been around for a long time. I think even before there was the term activist investor. I remember early on, the head of the trading desk where I worked, by the name of Howard Kelting, had a good friend who managed a closed-end fund, and I remember that she was actually hoping that someone looking to buy it out because it was at a discount would take over the fund. She would make a good profit from that herself, and I guess was looking to move on and do some other things. So I'd imagine there probably is a good body of research out on that phenomenon, and this is certainly a factor. I know that Saba, headed by Boaz Weinstein, has been active in this area. I think has been doing well at it, and it makes sense. I know that one part of the research is there's been a lot of work in the academic realm on the great mystery of closed-end funds selling at a discount, which in my mind is kind of in the category of the great mystery of why companies pay dividends. Academics are generally mystified by that, and we understand because it is less tax efficient than buying back stock, which of course has become a much bigger activity in recent years. But they're really mystified by why a closed-end fund would ever sell at a discount, given that the stock of the fund is made up and represents the value of all the underlying holdings. And of course, because activists cannot easily and swiftly, in every case, move in and close that gap by taking over the company, it is possible, particularly, and I wouldn't say it's in every case, but if it's the case that the management has not had a good record, it is going to trade at a discount. And I personally think it's a good thing that the activists are out there potentially helping to close those gaps and create some value in the market. But in terms of there probably are some studies out about their specific experience with it, but I have to admit I'm not as familiar as perhaps I should be with that literature. I think
Okay.
there was one came up.
There's another one. Robert Murray asked, what is your latest default forecast for high yield and leveraged loans, I assume?
Yeah, well, that's a great question. I actually have not made a practice of putting out a default rate forecast. I did a lot of work on that a number of years ago of trying to model default rates and come up with predictive models. But I think that the rating agencies have done a good job on that and working with a lot of data and putting a lot of resources into it. So what I've focused on more is the connection between those forecasts and what the market is saying. And if any of you if you are interested, I can send you a paper explaining why trying to back out the market's expected default rate forecast from the spread versus treasuries is the wrong approach, demonstrably flawed. The best way to do it that I've come up with is to look at the distress ratio. This is the percentage of issues in the index, or trading at a spread of 1,000 basis points or more. A concept I introduced and didn't think a lot of, but Rich Bernstein at Merrill Lynch pushed me to make greater use of that distress ratio, and it's become very productive. So if you look at the distress ratio times the distress default rate, and the distress default rate is the percentage of issues at distress levels that actually default, which is far less than 100%. And that distress default rate varies according to the distress ratio. In other words, the higher the distress ratio is, the lower the percentage that actually wind up defaulting. So if you work that all out, you're at about a 9% expected default rate according to the market for the next 12 months. And that's not out of line, I think, given that it's hard to be very precise about this, with S&P having recently stated that they expect the default rate to go to 10% on a trailing 12 months basis by the end of this year. Moody's went in their most recent update, I believe it was March 10th, had a pessimistic case of a little over 8%. I think that's realistically the right number to look at. I would expect that by the time they do the next update in about a week, that that number, the pessimist and maybe even the base case, will be more above that 8% level. So the point is that you cannot make the statement that the high yield market is way overdone it and is massively undervalued. I think it's very realistic about what it expects the default rate to be. If anything, that expected default rate might go a little bit higher as more earnings get reported and more information comes out about the companies, and it's clear that there are more that are at a genuine risk of failure.
All right, we have another question. Oh boy. Marty, will this be like Warren Buffett said, that when the tide goes out, you might see some business development companies that will truly be naked?
Well, I should say that I don't cover BDCs in my, and by the way, I sort of wear two hats, well, three. In addition to publishing the newsletter, which is focused on a range of income categories, including preferreds and closed-end funds, master limited partnerships, and REITs and other things. I publish the high yield research, of which some of this work is drawn, for leverage commentary and data. But my biggest activity is as a partner in a money management firm, also focused on income investing against a wide range of categories. We have not chosen to be particularly involved in the BDCs, so we're not doing a lot of work in that category, but I think it's very clear that that business has become much more competitive. It's been a good business, and that's drawn new entries, and there has been some intensification of the competition. Inevitably, that's going to put some pressure on spreads. So we may, in fact, find that there are at least particular participants in that market that run into trouble. I think some of the established companies that have the strongest reputations may have been able to hold the line better. Again, we'll find it, as Warren Buffett says, when the tide goes out, we'll find out. I would be surprised if we don't see some BDCs in that category, but I would be equally more surprised to see all of them wind up in that situation. That's almost never the case with financial services, and we've had many cases before of competition and spreads tightening and so on. But you really haven't historically seen everybody being totally decimated by an event like this. Well, there hasn't been one quite like this, but let's say by a recession.
Okay, C.P. Smith writes, are there studies or expectations on future given the Volcker rule impacts on liquidity and spreads? Question.
Yeah, well, the Volcker rule has already had a major effect, another leg down on what was never great liquidity in the high yield market to begin with, but it took another hit following the Great Recession from the Volcker rule. And it's very unfortunate because Paul Volcker has said that the rule that he had in mind could be summarized in a 2-page document. And of course, once the rule makers got involved, it got into hundreds of pages, to the point where dealers were really fearful that through no intention to violate any regulation, they would just be caught because the rules were so technical. And of course, the documentation of a trade saying we bought 500 bonds, 200 were to fill existing orders, 150 were, for this reason or that purpose and so on. And we claim that none of it was for proprietary trading, but it's just so cumbersome to fill out those kind of documents every time that it's not surprising there's been a cutback. And I believe that it's likely that from a risk management standpoint, because this event was so far off the charts, that any dealers who were sitting with significant positions at the time this hit and were not completely hedged, of course, those positions are smaller than they would have been in the past, but it wouldn't surprise me to see even further cutbacks in liquidity. And the result of this, of course, that salesman's role has been transformed. If it ever was as simple as bringing buyers and sellers together, and I think that would be demeaning the role of the salesman. I think that they did more than that, but more and more they really have to make trades happen by going out and finding people who are not offering bonds, but if talked to, would be willing to hit a bid if it were there. And it's a much more elaborate process than it was in the past to get those trades to happen. And unfortunately, I think that may become even more difficult. Certainly will be during this recession, and as long as we have huge volatility in the markets. But I think going beyond that, we may see another leg down.
All right. One more question. Let's see, what's the current default rate in the high yield bond market and leveraged loan market? From Martha Tuttle.
Yeah, well, it only in the latest 12 months, as reported by Moody's, was just 4.4%, and it's clearly going to go higher. The question is, do you go all the way to the peak in just a 1-year period? Historically, the norm has been to take a couple of years to get up to that peak, typically in the low double digits. but we may get there a lot faster if we find that this hit between the energy prices and the impact of the coronavirus, we may get there faster than we usually do. And certainly that's the expectation. I saw one sell-side firm, I believe, put out a 13% default rate forecast. I believe that was for the next 12 months. And I don't think that's an unrealistic number. I believe the leveraged loan number was more in the 2% range over the last 12 months. That's certainly going to go somewhat higher as well. You know, the leveraged loan index has a higher quality mix than the high yield index. So even though there's a lot of overlap in the companies that issue in those markets, that winds up being a factor. I do a relative value analysis of loans and bonds. I find that just looking at the spread isn't helpful, because you say that the spread is lower on loans than it is on bonds. Well, of course it is, because the average rating is higher there. So we go through an elaborate process of literally bond by bond to filter out the impact of that difference in quality. And before this really started to hit in a big way during February, the relationship went to an extreme cheapness relative to loans on the part of bonds, a total reversal from just 2 months earlier, where it was loans being extremely cheap versus bonds. That quick a change from one extreme to another was unprecedented in this series, although the series goes back only a limited number of years. But I've been vindicated in that analysis. I find that it's been validated by the fact that the issuers invariably, when you go from one extreme to another, usually over a longer period, they follow by issuing in the market that, of course, is most attractive to them and least attractive to the investor. I was saying that the average high yield bond is worse than average because issuers don't come to market when the terms are not grossly in their favor, both on spread and in covenant terms. So you don't really get a new issue calendar that represents average quality over time. You get the quality that's skewed in favor of the issuer, unfortunately, and there's not a lot that can be done about that, unfortunately. The issuers have the luxury of being able to issue in the market that's most favorable to them, or not issue at all because they don't let their maturities come up to be where they absolutely have to issue right at that time. Whereas the investors, if they're running a high yield fund, they don't have the luxury of going to 15 or 20% cash, because then they get criticized by the investors who say, we're paying you a high yield fee to manage a money market fund. That's not right. So they really have to take what's offered. Occasionally they can fight back on particularly egregious covenant terms, but they don't really have a lot of bargaining power when it comes to rate. That's just sort of a inherent factor in the nature of the high yield market. So I guess we've come to the end of the question. Again, let me encourage you, if you, do you have another question?
I'm trying to unmute Mark.
Okay, let me just say while he's coming on, again, encourage you if you have questions at a later point, Marty at Fridson.com. Would love to hear from you, and thank you very much for being in on this call and giving me the opportunity to I think is a terrific forum of Fixed Income Analyst Society.
Marty, thank you very much for sharing your wisdom, offering your insights, and reminding everybody on this call the importance of rigorous analysis. I think as a fellow old timer, I appreciate that we're in a very difficult period, but it also is going to be one that, as you just said, validates rigorous analysis. We've been through a period, not just the last decade of easy money, but even a period longer than that, where people didn't think corporate credit mattered that much, except in a few sectors like energy or real estate. And this sudden stop is going to have big implications for not just defaults, but the severity of the defaults, correlations of assets, a whole host of structured products that have been built off of credit, particularly corporate credit. And we really value your insights and thank you for spending the time with us at this important juncture. So thanks, Marty. Thanks to everyone who participated. And we look forward to seeing you join us in a future call, including with Marty coming back hopefully soon. Thank you.
I'd love to do it. Thank you.
And be safe.